Of what? That this is something more than a bear bounce?
Might be. So if you think about advances in the market of greater than 7%, which is what we had in the month of July, and what you're really doing is reversing June, right? Down significantly in June, you come back in July. What other times have you had that type of performance, Scott? Well, April of 2020, March of 2009. That's a very compelling reversal of a negative price performance. Subsequent to that, you have seen that it has been a market bottom, and you've had a very strong recovery that has followed thereafter. So I think we're also in a place where we still have a lot of skepticism. People do not, we're beginning the show talking about exactly that. And I think what you have to do is you have to kind of eradicate some of that skepticism. And that's why I think there's further upside. And it's reflected in my continued ownership of the QQQ.
Okay. Well, you have a whole bunch of rebalancings for the Joe T ETF.
Yep.
We'll get to all of those coming up. So names, sectors, new things, new ideas. Got rid of some stuff, added some new things. We're going to go through that in just a bit right here. What about you? How do you want to address this, whether this is a bear bounce or something more? Joe says you have to eradicate the skepticism. I think that's what he just said.
And he took
There's a lot of skepticism because maybe you need to see more before you can eradicate all of it.
Well, that's the truth, isn't it? That is the truth. But I like the step that Joe just took. He took a stance. Now, you know what my stance is. I mean, you know what my stance is. I do think the lows are in, and I think we're going higher from here. But why? Why? Okay, because what Joe is pointing out to the skepticism is that you can make a bull case and you can make a bear case very easily. And quite often it's on the same topic, right? The labor market is strong. That's bullish. But layoffs are picking up. That's bearish. The Fed funds futures are saying we're going to peak in a few months, but we haven't seen the lagged effects of the rate hikes so far. I can do that all day long. So I want to make this simple, and I'm going to tell you why I'm bullish. I'm going to go to a detail that to me matters. Gasoline futures broke below $3 a gallon today. Okay, 2.94 as we're looking right now. That's off 30% from the high, Scott, and you haven't seen that full 30% show up at the pumps. You just haven't. You've seen about half of it because it takes time to translate through from the refineries to the transporters to the distributors to the retailers. But it's going to show up. It's going to help consumption. It's going to help sentiment. It's going to help sentiment not just for consumers but for investors. I think that is yet to come. I think it's important. But what I'm really saying here is the single most important thing is inflation coming down, period.
Okay. You said the bull case can be made easily.
I did.
Got a note just dropped. Dubravko Lakos, JP Morgan says the following. We believe it is better than fairly valued, speaking of stocks right now, better than fairly valued given the shift in industry mix to higher quality companies. Although the activity outlook remains challenging, we believe that the risk reward for equities is looking more attractive as we move through the second half. Shannon, Piper Sandler today says the S&P year end 47.75. We believe the rally has more room to run. It may have more room to run, but is it still a bear bounce, or is it in fact something more like these two gentlemen in front of me think it might be?
Well, I think it's a little early to tell, but I think indications are, if you look at last week alone, Scott, we digested a negative GDP print. We digested an expected 75 basis points. But, 6 months ago, if we had been talking about 2 75 basis point hikes in a row, we would have thought the sky was falling. And so I think there is some grace being afforded to companies right now. Just look at EPS surprises, positive and negative EPS surprises. Both types of surprises are actually yielding stronger returns in the market. That, to me, says investors are looking at the landscape, looking at the next 6 months and saying, okay, we're preparing for the worst. Earnings growth is down. We're certainly down. It's probably going to be the worst quarter since the fourth quarter of 2020 in terms of year-over-year earnings growth. But this is exactly what we were expecting. And so I think if you think about that, could it be a bear market bounce? Absolutely, especially if we start to get some overhang from the midterms in October. If inflation turns out to be, we've got 2 prints, remember, before the September Fed meeting, if those turn out to continue to be moving higher. But I agree with Jim. Look at the commodity market. We haven't seen that flow through PPI yet, which means we haven't seen it through CPI. Those are trailing indicators. So is the employment market. But if I look at the landscape for companies, what management is saying, they are saying this is the environment that we're preparing for. High quality companies, free cash flow, strong management. That's where I don't think this is a bear market bounce. Those are the companies that I think can continue to perform well in the second half of this year.
Okay. By the way, it was Kalanovic, Marco Kalanovic, not Dubravko. Lekos. Kalanovic, he likes to drop these notes like right when we come on the air.
I think he does it on
12
purpose.
noon and he goes to lunch. He lets it marinate in the marketplace and sees what the conversation actually is. So, Brenda, bear bounce, something more. Just put in the best month since November of 2020. Foolhardy to believe that we can really build on this given what's still out there in front of us?
Yeah, I think it's probably a little something more, and especially because I think sentiment had just become clearly way too bearish heading into second quarter earnings. And so earnings have not turned out to be as bad as everybody thought, and market reaction has certainly been encouraging in that regard. But I do think that we need to see inflation starting to come down in the reported numbers, in the CPI numbers, and we just haven't seen that yet. Even though you could argue, in June, we were starting to see some indicators that suggested maybe we should see a little bit of softening within CPI, and it just hasn't happened. So I think, we get the next reading on August 10th, which I think is going to be important. I'm not sure, though, that it's really going to show a lot of meaningful change. But I think that is really what's needed for the next leg higher in this market. I don't think we're necessarily going back down, but I think we could be in for some more volatility if we don't start to see some real improvement in CPI.